Hello and welcome back to the channel. If you're watching the housing market or thinking about buying or refinancing, there's some interesting news out of the Treasury this morning that is moving mortgage bonds higher. The Treasury announced it will double the size of its buyback operations for longer dated Treasuries, including the 10-year, 20-year, and 30-year. Starting September 9th, they'll be buying roughly $5.5 billion per month. That's not massive compared to past Fed quantitative easing, but it's enough to give the bond market a real boost right now. Why does this matter for you? Mortgage rates tend to follow the 10-year Treasury yield. Yields had climbed to some of their highest levels in a long time. The 30-year hit a 20-year high, and the 10-year was at its strongest since January 2025. By stepping in to buy more of these longer bonds, the Treasury is helping push bond prices up and yields down a bit. That support is welcome in an environment where the government is still issuing a lot of debt and companies are also flooding the market with corporate bonds, which competes for the same investor dollars. Looking at the latest mortgage data, rates remain just above 6.75%. That's about 1/8% higher than this time last year. Application volume was basically flat week over week, but still running lower than a year ago. Purchase applications are down 3% year over year, and refinances are off 18%. There simply aren't many attractive rate and term refinance opportunities right now. On the housing side, the National Association of Realtors reported that pending home sales, those signed contracts on existing homes, fell 2.3% in July. That was weaker than expected, even after a small upward revision to the June numbers. Pending sales are now down 2.2% compared to a year ago. Realtors pointed to the highest rates of the year as the main reason contract signings pulled back, which makes sense. Technically, mortgage bonds bounced after the Treasury news, reclaiming some key levels. The 10-year yield held at 4.71% and is edged down toward a level it hasn't traded under since late June. If that support holds and yields can stay lower, it could open the door for a bit more relief in mortgage rates. Of course, nothing moves in a straight line, so we'll keep a close eye on whether these gains stick. Bottom line for consumers, rates are still elevated, and that's clearly weighing on both purchases and refinances. The Treasury's increased buybacks are a helpful tailwind for bonds right now, which could take a little pressure off rates in the weeks ahead. Whether you're shopping for a home or exploring a cash-out refinance, staying informed on these bond market moves is key. That's the update for today. Thanks for watching, and I'll see you in the next one.